the first trades you're looking at?
Well, yeah, I think HDFC Bank is now, I think, contributing some 79 points for the Nifty on the downside and more than 400 points for the Bank Nifty. So that's the only major reason why the markets or the indices are showing negative tick. In terms of opening trade, from the PSU name, Coal India, which looks attractive, the stock, even on Monday's trading session, managed to give a flag pattern breakout. So would expect a strong follow-through for Coal India going forward.
All right, let's find out what exactly Naresh has on his radar. Naresh, staring at the screen right now, a cut of about 0.6%. What is that indicative of? And run us through your first trade.
So again, the most impact comes from HDFC Bank, so not really looking at it. But overall stock specific, like Hero Moto Corp, a risk reward trade here at 3,090, 3,100 would keep a stop loss at 3,070.
Thank you for that, Naresh. Sanjeev Prasad joins us now, Managing Director and Kuwait with Kotak Institutional Equities. Sanjeev, good morning. Thank you for joining us. You said cat amongst the pigeon when 2 weeks ago Kotak came out with the release saying that we are officially stopping coverage in mid-cap stocks. What prompted you to come up with a report like this? I mean, it's a powerful statement, right?
No, first of all, big clarification. We have not stopped coverage of mid-cap stock. I don't know how that thing started. We have only dropped the model portfolio which I used to run, which most people wouldn't even have bothered with, to be honest with you. So I don't know what was the big hangama around, us dropping a 15 stock model portfolio. I don't know. We continue to cover several mid-cap stocks. In fact, all the mid-cap stock which we used to cover, everything is still under coverage. So
that you've stopped the model portfolio. What does that mean?
Right. Well, as we had written in the report, so many stocks run up so much in the past few months. Whatever stocks we had in the model portfolio, in most cases, the stocks were trading higher than our fair values. So obviously, it becomes very, irresponsible for a strategist or anybody to be recommending stocks where the fair value lower than the current market price. So the option was to, remove all the names where we were seeing this problem. In which case, would have been left with only some financial names. So I thought the better thing is, instead of having a portfolio which covers only mid-cap, banks and NBFCs, why just remove the entire thing? That's what we did.
In September, another report which says defensive stocks, no defense against any potential negatives. So I'll let you interpret this report. What do you mean by this report? 16 September.
Yeah, if you look at the reverse valuation exercise we have done, the kind of revenue numbers being implied in the short term by based on the current stock prices look fairly unachievable, I would say. So for the 8-9 stocks which we are looked at, which has did a reverse valuation exercise. So let's say the current market price and current market cap is this much. These companies will have to have a certain amount of that to justify the current market cap. And based on that fact, we need a certain amount of revenues to justify the current market cap. The numbers which are being thrown up suggest that the revenue number should be 2 times what this company delivered in FY23. So that is not going to happen in a short time frame of 1 to 2 years, right? So that's the point we're making, even though we are quite positive on the longer term story of more spending by the government on defense capex, more international taking place. We should all be positive for defense stock, but a lot of good news and more is actually getting priced in. So that's the limited point we're making out in many of these reports that we have been putting out, that we are not comfortable with the valuations.
At large also, Sanjeev, do you believe that the mid and the small cap end of the market may be getting a bit more frothy, and it may make sense to take chips off the table pretty much across the board if you are in the market for a slightly medium to short term kind of time frame, and maybe deploy that into the large caps?
If you look at most of the mid caps, small caps particularly, anything to do with the investment piece of the economy, whether it is capital goods or defense or renewables, railways, etc. They have all run up a lot in the last few months. I mean, you look at the stock charts, you will start wondering, what has happened, what has changed so dramatically for the stocks. Yes, obviously there have been some positive developments, and we are quite positive on the investment cycle going forward. But to justify, 100%, 12% moves in stocks in 6 months, that's impossible, right? I mean, what has changed fundamentally in some of the stocks to justify a 12% move in some of the stocks? So that's a limited point over here. They're just struggling to figure out the reasons for as to why the stocks have gone up so much. When at least the stocks recover, the fundamentals haven't really changed that much. So yeah, so in most cases, the stocks are looking very, very expensive. They're all factoring a lot of positive news. And if you do any sensible, reverse valuation exercise, in many cases, the implied volume numbers, profitability numbers, revenue numbers are completely out of whack, compared to whatever is possible in the next, let's say, 2 to 3 year frame. So my best sense here would be that many of the stocks could either price correct whenever that happens. It's possible to forecast, when the market mood changes, or it's possible that many of the stocks could just go through a long period of time correction. And we have seen that. I look at many of the stocks from 2007, 2008 bubble period. It took 7-8 years for many stocks to go back to the same level. You look at the mid caps in 2017-18. Again, you had this period of excess euphoria in the market at that time. Many of the mid caps struggled for the next 5 years after that. Again, we are seeing a period where expectations have run well ahead of the fundamentals. So my best sense here would be either the stock price is correct whenever they do. I'm not going to forecast all the stuff here. I have no expertise to forecast stock prices, or they will time correct over a period of time.
So, given this market construct that you just painted, Sanjeev, is there value anywhere on the table right now across the board and across market caps?
It's largely in the financial sector. So whether you look at the large cap banks, mid cap banks, and BFCs, or small caps, that's the only place where we see some value. Otherwise, consumption names are still very expensive. And the underlying environment for consumption is actually very, very weak. You have seen the numbers and the commentary from companies over the last 3 quarters. I mean, really, there is a struggle as far as consumption is concerned. When you look at our own GDP numbers, now 1Q FY 24 versus 1Q FY 20, 4 years CAGR for private consumption is 3.5%. So clearly, there is a challenge in the economy as far as consumption growth is concerned. And same way, when I look at the investment part piece, that all the stuff which falls on investment, everything is looking so expensive over there. As I said earlier, we are very positive on the investment cycle, but the way the stocks run up, it's just very hard to justify the valuations, based on the fundamentals, what we are seeing for the time being. Same way, if I look at the housing names, maybe you can make some case for some of the IT names, some of the pharma names. They're probably, slightly ahead of fundamentals. But beyond, I would say, financials and some of the outsourcing names, they're just struggling for ideas at this point in time.
Okay. So there are two...
Okay, sorry, 1 second. I think you guys need to correct that header over there, stoppage coverage on stocks and all that stuff.
No, we've got... So the flash which is going on... The flash which is going on is actually what you just said, and I'm glad we're having a chat around this, that stop coverage on stocks where valuations are expensive. I think that's the perfect messaging, right?
We have not stopped coverage here. Who is saying we have stopped coverage? We have coverage of stocks, we are maintaining ratings. So what is this thing about stopping coverage?
Continue to cover several mid-cap stocks. It's only model portfolio where the stocks were expensive. You've not continued with the model portfolio.
The model portfolio is just something to recommend to investors. That's it. So we have dropped the model portfolio, but we're not dropped coverage of the stocks here. Just to clarify, once and for heaven's sake, man, don't get me into trouble.
Get the flash right, and I will send you a WhatsApp message after that. Don't worry. Don't worry. We don't want to. I'm glad we're having this chat. At least this clarifies. That report, by the way, actually attracted a lot of attention, and more than media attention.
I don't want to get in trouble with the Indian people here.
No. Don't worry about that. Okay, so let's understand what should be the best strategy in this kind of a market. Now, whether it's defense or railways or power, the level of participation has been strong. So for those who own these stocks and who can digest a 20-25% volatility, should they call them as mega trends and stick to them for next 3-5 years?
Well, you can stick to them, but you're probably not going to make a lot of money given the way the valuations are run up. So they are pricing a lot of growth. That's a problem. A lot of growth for next 3-4 years is probably already priced in. So how do you make money in that case here? So you think that what would happen is even the earnings will come through, volume growth will come through, revenues will come through. I'm not debating on that. You will see growth in most sectors in the country. But you will probably see multiples coming down at the same time, which means your stock price returns may be very, very muted going forward. I mean, it's a simple, fact of valuations here. Valuation high, the chances of making money is probably low. Everything else remaining the same. So there's no rocket science we are trying to explain over here.
One sector which we distinctly discussed last time was autos, and you were not comfortable with valuations in autos, and now mixed picture seems to be coming out. While auto companies are saying inventory built up is largely because of the pre-festival demand, frankly, the ground evidence seems to be indicating that demand is not as strong as what it was, let's say, 6-8 months ago. So you don't think somewhere markets will be in for some rude shockers post this entire festival season when it comes to autos?
Well, I hope the festival season really results in demand picking up, because everybody is sort of waiting for that, because the narrative has shifted from recovery in the March quarter to the June quarter, then good monsoons, which unfortunately haven't really played out, now to the festive season, and then maybe to the election spending and whatnot. So I just hope the festival season really results in or shows a big pickup in demand. Otherwise, the stocks could actually see a big correction. See, the stocks are run up a lot in anticipation of volume recovery, which is still not taking place, at least based on whatever data we are seeing till August. And even if you look at September retail data, which comes out every day, you can track that on the government side. It's again not really showing any real pickup in volumes over there. So underlying retail demand still is fairly muted, and this is true pretty much across the board, I would say. And the other reason why the stocks went up was a big improvement in profitability starting from 3Q of FY23. That's a December 2022 quarter, because of the decline in commodity prices. Since then, obviously, oil prices have gone up, even though they were not having on the cost of ownership for Indian households, given the fact that you're not seeing any change in diesel or petrol prices. But yeah, we're starting slowly but surely, starting to see some increase in again material prices, and given the fact rupee depreciated in rupee terms again, the raw material prices are starting to move up once again. So the worry over here is if volumes don't pick up and profitability or gross margins, EBITDA margins start coming under pressure, how does the market react to that? Because currently a lot of good news and probably more is getting priced in terms of volume recovery and very high, EBITDA margin, which we have seen in the 1Q FY24, that's sustaining for the rest of the year and beyond.
All right, Sanjeev, good to have you on board. Thanks so much for joining in, clarifying those details, and of course, sharing with us your view on the markets. Just a quick check-in as to what the index is up to while continuing to hover around the 20,037 mark. It's the broader end of the market that's mildly eked into the green. Within the broader universe, just flagging off some of the winners. Blue Star, Varroc Engineering having a good run, something like a Graphite India. We've been flagging off Vodafone Idea as well. That stock is a buzz. NBCC and something like a JK Tires too is up and about in trade. There have been some multiple block deals on Reliance Industries, so continue to track that stock at about 23.95. But lots going on in the real estate space as well. What's the outlook when it comes to the housing demand? Are there new project launches when it comes to DLF? We've got Ashok Tyagi, the managing director, right here with us to answer that and lots more. Mr. Tyagi, welcome to ET Now. Thanks so much for joining in. Let's begin by just talking about the residential market and the Delhi NCR region in particular. Gurugram has been performing quite well. Give us a sense as to what the outlook is in terms of demand on ground.
Okay, so good morning. So clearly, it's now been a consistent story for more than eight quarters plus that the demand is very buoyant. In fact, it's growing stronger, I'd say, by the quarter. We had that successful launch in March of last year, and we have a launch pipeline lined up for most of it for the second half of this year, though a couple of smaller launches are happening now also. And I think we are, frankly, the entire market is looking pretty strong right now. And it's really, it's across segments from the super luxury, premium, if at all there's been some slowdown, possibly it's been on the lower end of the market because of the increased EMI rates, etc. But really, most of the premium and premium plus categories where we typically operate in are actually very strong.
Mr. Tyagi, good morning. When we spoke to you last time, DLF management was celebrating. They were almost doing Bhangra on ET Now because of that big launch where one shot you were able to raise about $1 billion plus kind of in booking. So which is the next big one which will entice you to do Bhangra?
So we are in the north, Bhangra is in our veins. So,
Okay.
Anyway, but on a more serious thing, the fact is that I think in the second half of this year, we have two major launches lined up in Gurgaon, and possibly one more launch lined up in the Chandigarh Tri-City. We have one tower of our Central Delhi project also lined up for the final launch. So I think we clearly have these 3 or 4 launches. I mean, we also hopefully before at least the end of, if not Q4, latest by Q1 next year, we should have our phase 1 launch in Mumbai. And we will possibly have launches in both Goa and Chennai in the next 9 months period.
Why has demand been so strong? And I'm saying purely out of curiosity, because it's not that anything dramatic has changed in the last 1.5 years. I mean, we had a COVID sugar rush that forced everyone to buy more residential, work at home, low interest rates, those factors were at play. But post that, inflation has been high, real estate prices have been high, but demand is still robust. What is the macro which is driving this robustness?
So honestly, Nikunj, I mean, I'm not an economist really, but the fact is that you are correct that the demand has been strong. It's braved the interest rate cycle. Hopefully, now that we are at possibly the fag end of the interest rate hike cycle, things are looking even more sort of, stable going forward. But the fact is that, in fact, originally the demand kickback happened from like the lower and the budget end of the market. Then it sort of spread upwards, right, to the luxury and the super luxury. And I think at least there is possibly, despite the inflation, I think there is clearly a greater sense of optimism, at least in the upper middle classes and the classes beyond them, for sure, which I think is one of the big reasons driving this entire housing boom. The second thing, of course, also, which is very important, is that the supply has shrunk. In each micro market, really, if you see, the supply is basically now coming from the 6 to 8 big organized players. And, those smaller developers who at one time used to have a large chunk of the market, at least in NCR for sure, are clearly no longer active. So really, I mean, there are few suppliers who are becoming more sensible and more focused in their supply, and that is matched up with a boosting demand, which is possibly resulting in. So the situation is good, but it's possibly even better for the organized developers.
And Mr. Tyagi, is it at all leading to some price escalation? Because some of the channel checks do seem to indicate that at least in the Delhi NCR region, we have seen a price uptick.
No, absolutely. In fact, last couple of years, there has been price increases, and I mean, which really have been what the market has absorbed. So, I mean, in retrospect, what the market analysts tell us is that the reason Arbor, or not the reason, but one of the primary drivers for the Arbor sale was that while we thought we are outpricing the then market on that micro segment, possibly the market was expecting even a higher price, in that sense. So clearly there is a price positivity that is generally there. Of course, I think the players would have to be responsible in ensuring that they don't outprice themselves at any stage. But you are correct that at least for the credible developers, there is clearly a price positivity that is currently going on in at least the NCR market.
So let me put the maths here. Your net debt is lowest. Order outlook or the booking outlook is strong. Pricing uptick has started. So will it be a stretch if I say that DLF possibility could be a zero net debt company by end of FY24? Am I assuming it right?
Nikunj, we were at 57 crores net debt as of June 30th, and so we are almost, it doesn't take 9 months to get 57 down to zero, really. So hopefully we should be net debt zero far earlier than the end of fiscal. You are correct. So debt is no longer an issue, frankly, in that sense. If at all, we choose to sort of thing, have some debt, it's predominantly to counteract the fact that a large part of our cash balances going forward will be trapped in the RERA escrows. So at times, you may still have some gross debt on the books, even though your net debt may continue to be zero or negative.
I'm saying it's a messaging, sir. Which is what I'm trying to bring out on the positive side, that for a company 10 years ago where there was debt challenge, yes, and you had to sell non-core assets to bring the debt down, both at an operating level and at a net level, you hopefully would be a zero net debt company in this financial year. What a turnaround it's been. I look at the positive side here.
No, no, absolutely. Thank you so much. It's been a long and a hard journey, as you know. I mean, you have been a keen observer of our company for a very long time, so you've seen these struggles. But yeah, hopefully, those days are possibly behind us now.
We understand that there is a lot of built up capacity in SEZs, and there could be a change in terms of how those locked up land constructed banks would be out in terms of the commercial market. If that has to happen, how will this change dynamics for the commercial sector and for DLF?
Okay, so great question, Nikunj. I mean, really, if you see today, our total offices vacancy is about 9 or 10% of the total stock. But it's clearly higher in the SEZ space and lower in the non-SEZ space. I mean, all of us have been waiting keenly for the so-called DESH guidelines to be notified, which hopefully should permit the SEZ players to denotify their buildings partially and use them for normal commercial usages, and non-SEZ uses. Because as you know, the direct tax benefits of the SEZ spaces are gone now, so there is a lesser incentive for the new tenants to go into SEZs. So that's one thing which and as you must have seen in the case of listed REITs also, that they are also possibly struggling with that. And I think we are all hopeful and optimistic that between the Ministry of Commerce and the Ministry of Finance, they should hopefully at some stage notify the guidelines for conversion of SEZ to non-SEZ spaces. And I think that should clearly free up and hopefully, put a greater driver to the locked up space in SEZs currently.
How much space does DLF have? And if the guidelines are to be implemented, let's say in FY24, what changes for DLF?
So clearly, I think the vacancy levels, which currently in the SEZ spaces are I think in the early to mid-teens. I think there's no reason why over a period of 1 year after the re-notification, they should not come back to the same 5-6% vacancy levels that exist for us in the non-SEZ spaces. So I think clearly there will be a significant vacancy absorption. The good news is that a large part of our older SEZs have a very high vacancy absorption, and this should still free up, I think, at least hopefully 1 million square feet plus of spaces which in our office portfolio.
Tyagi, now DLF is concentrated in and around NCR, but you're coming back to Bombay, you moved to Chennai, you just mentioned Goa. Why are you diversifying? And if you're diversifying this small, diversification, how much will that be in terms of an aggregate needle moving change for DLF? Is it worth it?
Okay. No, so good point. So just to clarify, on the commercial office business, we already have had a sizable presence in Chennai. In fact, in the next 2 or 3 years, we should be almost at almost a 15 million square feet installed capacity in Chennai of offices. We have a presence in Hyderabad for a very long time, which we are now building up further because Hyderabad and Chennai are major office markets, and we've been there for the last, I think, 15 odd years now. On the residential piece, you are correct that maybe apart from Mumbai, which is a new entry, in both Goa, Chennai, and some other locations, we are not buying land. These were land parcels that we had acquired in the 2008 to 2010-11 time frame, those buoyant times. And frankly, while many of the land parcels in those geographies we had monetized as land parcels in the 2010s, now clearly, given the market tailwinds, we believe that the best method of using these land parcels is to actually build and develop these land parcels, which is the reason why at least we have 2 clear land parcels in Tamil Nadu. We have a wonderful land parcel in Goa, and I think we clearly believe that given the market situation today, maybe the best situation is for us to develop these as developed projects and then monetize them through that route versus trying to sell them as land, which we would have done 5 years back.
Couple of final questions. If one has to understand the way how the scenario is moving in the luxury real estate market, because that's where the exciting things are. If one looks at some of your marquee properties, the Camellias, I'm forgetting the names, but Aralias.
Magnolias, Crest, yeah.
Yes, you've not invited me, so I only know one name, sir. See,
I नहीं सर,
एक ही नाम पता है, वो भी कजन रहते हैं तो पता है, आपने तो इनवाइट ही नहीं करा. नेक्स्ट टाइम आई विल रिमेंबर इट वंस आई गेट एन इनविटेशन फ्रॉम यू. इट इज ओनली आयशा, शी प्रॉम्प्टेड मी, मैं नाम भी भूल गया था, इतनी वहाँ की कंस्ट्रक्शन है, आई फॉरगॉट द नेम्स. दैट्स द लग्जरी मार्केट which has done very well. Across India, luxury is doing very well. What is your understanding of luxury market?
So clearly, I think the 2 or 3 pieces. One is clearly that possibly the luxury segment customer has been less impacted by some of the macroeconomic challenges that they say the mid-income customer may have faced, including the hike in interest rates and EMIs and those sort of things. Clearly, the luxury segment owner has become possibly even more aspirational in terms of what they want from their product. And I mean, frankly, the entire acceleration in the pace of sale of camellias, the resale pricing in products like Crest and Magnolias, I mean, those have been just sort of, started really accelerating. Our launch in Central Delhi, which is in the price points of about 20 to 23,000 rupees a square foot, is also doing extraordinarily well. So clearly, I think there's a positivity bias towards the luxury segment right now. Also, frankly, at least in NCR, unlike say Mumbai, there is not there's not a huge supply of the luxury segments here as well, in that sense. So frankly, there are customers who have the deep pockets to buy this stuff, and they don't have too many of competing products to buy from. So really, I mean, there's a push for camellias, there's a push for resale market Crest, resale market Magnolias, and those sort of products. And we expect this to continue. In fact, one of our 2 launches this year, hopefully, should be in this luxury or super luxury space on the Golf Course Road.
All right. So looking forward to our invitation and coming to visit very soon. Thank you, Mr. Tyagi, for joining us on ET Now. All right, we'll take a very short break right here on the show. Be right back for lots more news and updates.
Uncle.
To sales, talk a little bit more about new launches when it comes to Bajaj Auto. Rakesh Sharma is the ED now joining us on the show. Thanks so much for taking time out. Tell us, what have festive sales been like up until now? What's the expectation? Which segments do you believe Mr. Sharma could really propel growth?
Good morning. I must say that the festive has just started, so it's a little bit early to start to give a verdict on festive sales. But if we rewind a little bit, then I must say that the last quarter, which is quarter 1 and quarter 2, July and August, have seen a little bit of a turnaround in retail terms compared to the previous year. Till about quarter 4, the industry was still in decline. But towards the end of quarter 1, and then certainly in July and August, we have seen an uptick in the industry. This is, in our opinion, being driven by the top half of the industry, which is the 125cc plus segments, which constitute almost 50%, a shade under 50% of the industry. That is growing at a faster pace than the bottom half. The demand at this point of time seems to be evenly spread across urban centers and rural centers. Retail financing is progressing very well. We are seeing tenures of loans going up, which is a very good indication, because that suggests that people have confidence in a continued stream of income based on which they are taking longer tenure loans. So I would say that the curve has sort of turned around, and now we are looking directionally upwards. But I would say that we are still in middle single digit, 6 to 8% growth levels in terms of retails.
Good morning. Nikunj also joining in. So nice to connect with you. When we spoke last time, and I'm just going to quote part of our last interaction, you said that domestic market could pick up. You are excited about which way the global demand, export demand is moving. But given that commodity prices have stabilized, things are looking up at least in Asia and in Africa, Is there reason to get actually more excited about exports recovery faster than the retail recovery?
The performance of the domestic markets is far superior and therefore more exciting. I think the exports recovery has commenced, and quarter one was better than quarter four in retail terms for us also. And quarter two is seeming to be better than quarter one. However, it's improving in bits and pieces. I would say it's like a sharp recovery, but it's like, quarter one was better than quarter four by about 3-4%. And similarly, quarter two is better than quarter one by about 3-4%. I think we will continue to see an improvement, but it is going to be slow and steady. And you see, the issue is internationally, there are two issues, as I probably would have mentioned last time. One is that inflation has ravaged these emerging market economies. And that is still not coming under control because the dollar is stronger compared to these currencies and they continue to devalue, which means that a lot of these economies are very foreign trade dependent and their exposure to currency volatility is very high. So therefore, inflation remains an issue in some of these countries. And second is the availability of the dollar for trade, which is improving. So when you put both of these things together, one sees that yes, there will be recovery, but it's going to be slow and steady, which we are happy about. The free fall has flattened out, and at least we are back into the positive territory now.
So the big trend within the auto sector, the big trend is that everybody wants more at the same price, which is more power, more mileage, and more CC bikes. So when the domestic buyer in India will come back, do you think they will come back at entry level, or they would come back in premium, or they would come back in mid-range?
So this is not a trend. This is a phenomena. It's a feature of the Indian market that, and in particularly our category, that people are really driven foremost by value for money reasons. And it's a capital economy, so one can understand that. And the second thing is we have to understand that 70-80% of motorcycle customers earn less than 40,000 rupees per month. So that is the segment which we are talking about. And therefore, this segment is always thrusting for value for money propositions. Which segment will perform better is really an outcome of the nature of the economic recovery. 6 months back, the nature of the economic recovery was really in the top half of our demand segments, people who were better off, who had some better savings. The economic recovery had not yet reached people at the lower segments. Now one is finding that there is some bit of confidence which is appearing over there, and people are willing to come out and spend some money. And what happens is that when the times are tough, and actually a lot of the savings have got impaired because of COVID, then this adventurism in purchase gets curtailed, and you go back to a higher value for money. And that phenomena could be at any level. It could be at a super premium level, it could be premium level, it could be mid-level. Now, and just to quote, a customer who told me that he doesn't have enough money to buy cheap. So they're very careful. They don't want to just buy on price and have a service problem or a maintenance problem. Therefore, you start to see the recovery in the mid-range and certainly in the top range. Mid-range because it makes better sense. Top range because that is the customer who is recovering faster. And that when you put these two things together, that is what is standing out, that the better products are doing much better than the price-led products.
Okay, what is the outlook, Mr. Sharma, when it comes to the plans to ramp up the electric two-wheeler production? Can you walk us through what the targets are, how much you're looking at in terms of units per month?
Well, we are right now unlocked the capacities, and we are right now at between the 8,000 to 10,000 levels and in per month for Chetak. And we should be able to move this up to 10 to 15,000 kind of levels by Q4. And then we will see beyond that how the market is shaping up, which way the winds are blowing when it comes to the subsidy support, because the subsidy is a very, very important factor, which is strengthening the economic proposition of electric two-wheelers and aiding the migration from ICE two-wheelers to electric wheelers. So we have to keep that into account. We know that there is a fault line in March by when the policy should get clarified going forward. The previous clarification, which happened suddenly in May, did retard the growth. It is still growing, but at a much lower level. So that's our sort of broad plan in terms of capacities and the kind of volumes we are intending to pursue.
Will you be a bit aggressive then once there is clarity on the policy front when it comes to product launches? Because we are seeing a lot of OEMs as well expand their product basket. What is your sense in terms of those plans?
Yeah, so in the next quarter, you will see an expansion in the Chetak portfolio. And when we hit the next financial year, there will be, by then, what is going to happen is that hopefully the electric two-wheeler segment is going to be much bigger, which then gives you opportunities to sub-segment the market. Just throwing more and more models and then fracturing the demand and your own retails over multiple models which have marginal differences between them is not as productive. But we are anticipating that this segment will obviously be bigger. It's continually, the penetration in the scooters is increasing. It stands at about 15% now. And we are anticipating that this is going to give us opportunities to sub-segment the market and have meaningful introductions which deliver different propositions. And this you will see this happening in the next financial year.
What's your outlook in terms of launches of electric three-wheelers? The pilot launch, I understand, has been done in a few cities. What has been the response till date? What is the expectation that you have from the sales here in the longer term? And what kind of a cannibalization impact, if I may, will be expected?
Yeah, about a couple of months ago, we launched the electric three-wheeler very selectively in Uttar Pradesh. And we have had an absolutely outstanding response. We had to take a step back because a few months ago when we went in, we realized that we needed to improve the proposition a bit. So we strengthened that and we launched it a couple of months ago. And I can tell you that we are already, wherever we are where we started, we are at leadership market share already. We are therefore now scaling up, and scaling up means not just at the front end, entering more and more cities, but also at the back end, ensuring that the supply chain is now going to be able to deliver the increased demand now that the acceptance of the product has been absolutely magnificent. The cannibalization is very slender because most of these cities, the auto rickshaw is not allowed because they are under the permit system. And for many years now, the ICE autos have, even CNG autos have not been permitted in these cities. And therefore, this is almost entirely new business. And what happened when the autos were not permitted to, no new permits were being issued for autos, demand for intra-city transport and mobility continued to surge. And that was then being satisfied with what we call e-rickshaws, which have become a huge phenomena in the north and the east. And wherever we have now launched our e-autos, it has cannibalized these e-rickshaws, particularly those people who have been plying e-rickshaws for 1 or 2 years, know that it's not a durable product, and they finally want to get into a very legitimate sound product, and that is where the e-auto steps in. So in that way, as we scale up, at least for quite some time, we feel this is absolutely new business for us.
Thank you for joining us and giving us a lot more clarity on business, festive sales, and what you're expecting as well from the electric two-wheeler and three-wheeler market. All right. On that note, we'll take a very quick break and be right back. And we're expecting the debut of consumer electrical products manufacturer, that is RR Cable, that is going to list in just moments from now. And it is expected that it could be a fairly decent listing premium that we could see close to 10 to 15%. Do remember the issue price is at about 1,035, and there you have it. Yes, indeed. It has been a 14% premium to that, around 1175 to about 1180. Do remember the public issue has seen pretty strong response as well. And owing to that is the reason that we were expecting this positive momentum as well. Do remember the IPO was subscribed about 18.6 times. A lot of support as well from the qualified institutional investors and HNIs. So that is the listing of the day. But let's shift gears then and move away from that. We've got a special conversation lined up with Nikunj Mishra on his India strategy. I'm going to hand it over to Nikunj to take that forward. Nikunj?
Well, it gives me great pleasure now to welcome on board Nikunj Mishra, Chief Economist, Axis Bank, and Head of Global Research with Axis Capital. In fact, it's for the first time we are interacting with him in his new avatar. So nice to have him back. I've always maintained that his ability to spot the mega trend, throw in the macro aspect, talk about valuations, and then throw in that extra dimension of micro is quite extraordinary. So this is one interview I always look forward to learn, understand, and to decipher the big trends. So nice to have you back on Mr. Mishra. How's the new innings?
Pleasure to be back. Thank you for having me.
How has life changed for you?
Oh, it's busier than ever. There are a lot more ideas that I can now explore compared to what I used to do in my earlier avatar. So very exciting times.
So let's take a deep dive. First, what is your understanding of the world? US looks like has averted a recession. China has not come back on expected lines. And Indian markets and Indian economy is getting more and more glorified in terms of both global opinion and also in terms of trajectory. How would you connect the big picture first for us?
So let's take one layer off the observations you made, which as usual are quite on the spot, on the dot. So the reason why the US recession has not occurred yet is because of a significant expansion in the US fiscal deficit. So they're effectively adding $1 trillion of debt every month. I think most people who expected that hike in interest rates would drive a US recession had not anticipated that their annualized fiscal deficit would be upwards of 8% of GDP in this year. Now, that itself has its own ramifications. So the risk-free rate for the world, which is the 10-year US bond, the yield on the 10-year US bond, is now at 4.37. And in fact, what we have been researching and flagging is that a lot of this 2% point increase in the 10-year bond yield in the US, which is the risk-free rate for the world, is something that is going to last for a while. It is very difficult for that rate to come down. One very simple observation to support that is that one of the reasons the US fiscal deficit is so high is that their tax collections are not good enough. And so this means that some of the valuations that the markets have been used to, and in the 10 years preceding COVID, where the US mostly had a tight fiscal loose monetary stance, and now they seem to have a tight monetary loose fiscal stance, will mean that the PE multiples that we are used to will not apply. The muscle memory of the market will be tested. On the China side, if you unpeel one layer, the market has actually started feeling a bit more comfortable given the last month's data and the last couple of weeks. We are seeing some recovery in demand. Even the August retail sales did slightly better than expected. The underlying trend is still very worrying, which is that they have to go back to the old strategy of triggering more or supporting real estate construction, more infrastructure construction, whereas that only worsens the medium and long term. So the medium-term outlook for the world economy actually does not look very promising. And I think there should be in the next maybe 12 months. It is not immediate. Let me say that some of the risks we are talking about will likely play out over 12, 24 months and not 3 to 6 months. But these are things that we have to keep at the back of our mind.
Okay, so it will have two implications, economic implications and implications for the financial market. And we've always debated in the past that what happens to the financial market sometimes in the short to medium term could be independent of the real economy. If your view is that next 12 to 18 months may not be all that sanguine for global global economies, what does that mean for India and what does that mean for Indian financial markets?
So, as much as we would like, we are not an island, and our interconnections to the world are much deeper than they were, say, 30 years back, 20 years back. So incrementally, we are getting more and more connected to the rest of the world. And therefore, there will be risks. There are risks on our services exports slowing down in the near term. Medium term, I'm very positive, and I think it's going to be a great growth story, a great growth driver over the next 3 to 5 years. But in the near term, I think there are risks to that. There is already visible risk. We are seeing goods exports slow down. There is a very meaningful risk of the Chinese imports, or I would say the global goods oversupply that results from firms having overinvested because of the price surge that we saw in 2021 and 22 into capacities. And now the global goods demand is running well below trend. And that means that there's an oversupply of goods in the world, and therefore India's manufacturing competitiveness will be tested. And that will mean that we could see more and more imports starting to happen. And it would be unclear, at least for several months, if not quarters, whether this requires import protection or duty protection. So those are the risks that I think we need to be wary of. What may happen, maybe when the loan rollovers in the US start really accelerating, which is maybe following second quarter in 2024, which is June quarter 2024. It's only after that I think the risk of failed loan rollovers starts to become meaningful. Around that time, I think the risk premium in the market. So right now, volatility in the bond market, volatility in the equity markets is at very low levels. And therefore, people are speculating quite freely. But those are things that we have to keep in the back of our minds.
Mr. Mishra, just when it appeared that world is getting a handle on inflation, despite demand from China, crude is up. Olive oil prices, I was reading in the morning, up 100%. Edible oil prices have gone up. Copper prices have gone up. So if demand is getting constrained more and more, what explains this asset price inflation?
So the commodity price inflation is the edible oil. Clearly, I mean, if El Nino is as bad as the rains in India seem to show, then it is going to hurt the plantations in Malaysia and Indonesia as well. In crude oil, you must have seen that the strategic reserves in the US are now at 30-year lows, and someone seems to have woken up. There has been a restocking of the strategic petroleum reserves in the US. And then copper, it's about China going back into, even if temporarily, into that old mode that, so they know that they cannot keep reinvesting in real estate. They cannot keep building infrastructure, which can become a bigger problem incrementally in the next couple of years. But at the same time, if they don't do that, the economy starts to struggle. So they are currently in that mode. And then plus, of course, the fact that the battery market in the world is is seeing a lot of industrial policy intervention. So every country, in fact, Axis Capital recently put out a deep dive into how much subsidy is being thrown into batteries by the US, by China. And what that means is that the EV market will do better than was expected, say, even 1 year back. And which means, stronger demand for everything related to EVs and renewable energy. And therefore, demand for copper also starts to get boosted.
I'd like to draw your attention to what, in a sense, is the biggest global narrative, and that is China plus one. Manufacturing seems to be moving away from China for strategic reasons and because of political reasons. Indian markets and Indian economy have benefited from that. Do you think this is real and this is a trend in making for next couple of years?
It is definitely real, and it has to play out over the next couple of years. I think it is important for us not to be impatient when we are looking at the results of this. So if you look at the numbers, the Chinese goods exports, or Chinese share of global goods exports, has actually gone up in the last 2-3 years. So what you're seeing is, even if you measure, say, the share of US imports coming from China, that has dropped off very sharply, but it's just crossing the border into Vietnam. And so a lot of the export value add is still happening in China. See, these are supply chains which are very hard to shift, and the shift is going to be a very slow process. Is India benefiting from it? I think it is. We are seeing, for example, smartphone exports, which were from India, which were 45,000 crores in FY22, were supposed to be 75,000 crores in FY23. They turned out to be 89,000 crores. This year's target expectation was 140,000. It is possibly going to breach that very easily. So the growth is very substantial in a market, in a global smartphone market, which is actually slowing. So it has gone from 1.6 billion units to 1.2 billion units. And this is a clear example of China plus one. There are some other sectors where this is happening. I think a lot more can happen if we can improve our ability to give comfort to multinationals, global multinationals, that India has regulatory certainty, and we can give them that certainty much faster. So just for perspective, in 2005, about 18 years back, 58% of Chinese goods exports were from multinationals using China as a manufacturing base. So it was not for Chinese demand, it was just foreign firms using China as an export hub. Even today, 31% of Chinese goods exports are by multinationals operating in China, more than $1 trillion. If India has to take that share very quickly, at least for the next 3 to 5 years, I think we have to focus on foreign firms using India as a manufacturing base. And for that to happen, we need to speed up the pace at which we sign advance pricing agreements. We need to speed up the pace at which we provide clearances on land or labor and so on and so forth. And this is a great opportunity over the next 1 or 2 years. And if we can speed that up, then I think we will be, over the medium term, much bigger beneficiaries of the China plus one trend.
CapEx, something which we've discussed over the years with you, seems to be focused around infra development. Road has been a resounding success. Now it's tilting towards defense and railways. And while the shift is happening, stock markets, when I say stock market, equity markets have been mighty excited. We both are aware of the rally what defense stocks and railway stocks and shipbuilding stocks have seen. What is the right way of understanding these government commitments towards shipbuilding, road, defense, railways? And if you could connect the equity market outlook also for us.
So the central government, so these are the sectors that it has not a monopoly on, but it can control directly. And therefore, national highways, railways, so these are central subjects. Defense these are central subjects, and this is where the central government can play a big role. On the road side, I think the pace of construction is unlikely to, it's unreasonable to expect that if you're already doing 16,000 kilometers a year, that you will be able to do much more than say 18-20,000 kilometers a year. So incremental growth in terms of the pace of construction at a national highway level may not really accelerate from here. What can happen and is likely to, and it seems to be happening, is that state highways. So there are lots of work happening in Maharashtra, in Uttar Pradesh, in several states where state highway construction is also accelerating. So that's where perhaps there can be some acceleration. But if you have a 2 lakh kilometers of national highway network and you are repairing everything once every 10 years, it is very hard to envisage, unless you are doing a lot of fresh alignments, a big expansion beyond 20,000 kilometers a year. On the railway side, I think the scope to do work is quite significant. Railway as a share of freight, the railway share of freight had been falling since independence. I think the last 2 years that number has started to inch up, and it has to rise substantially from where we are now. And that requires, I think, a steady pace of investment, and not just on the freight side. I think there is enough investment that is necessary on the passenger side to improve the quality of travel, the comfort level, and all that. And the problem so far has been that the railways they struggle to invest. So the availability of fiscal resources is not a constraint, it's their ability to execute. But very hearteningly, we have seen in the last 2 years that there is a pickup in that pace as well. On defense, I think it's a medium-term opportunity, meaning that we know that there is going to be more focus on Atmanirbharta, that is more self-dependence. Globally, spending on defense is starting to go up. And when we think about defense, we have to think beyond just the final assembly of submarines or the final assembly of planes. It has to be the whole ecosystem. Special types of casting, special types of forging, special types of materials, software, electronics. So there's a lot of stuff that goes into defense procurement. I think what we are seeing in the markets is that people do this top-down macro investing, and they say, okay, so I think defense is going to do very well, and therefore let's go and buy the few stocks that exist. Now, I think what is starting to happen, there are many of these stocks I won't cover, and I don't think it's appropriate for me to talk on specific names. But as a theme, I'm observing that because everyone wants to invest in defense, everyone wants to invest in railways, there is a very steady rise in price to earnings multiples without an appropriate visibility on what's happening to their own order books. Will they be able to participate in this? Will they be able to compete in this? So even on, say, something like electronics, I think there is a very good probability that India's electronics ecosystem will continue to grow. There will be a higher share of value add in 5-7 years. There will be lots of new activity and fascinating activity that comes up. But does that mean that every electronics company needs to trade at 45-50 times earnings? Given that their share of value add is low, they will have to take a lot of business risk. And those are questions that I think the markets are not asking appropriately. And there is, I think, in many of these names, quite a bit of froth.
One amongst the few who called out the COVID recovery right in terms of the shape. You said it would be a divided recovery, and I think now it's visible. It's a K-shaped recovery. Rural under stress, urban and ultra-luxury doing exceedingly well. Now, given that if economy has to grow at 6.5 to 7%, it needs a full participation. How long this divided picture could last? It's more like a fractured economy right now we are staring at.
I think that picture is a bit different from the way you characterized it right now. While that may have been the case, and that was the case about maybe 6-8 months back, I think that system is shifting. And I think on your show as well, we have discussed this in the past. When you have an economy forced into a lockdown and consumption of services slows down and construction slows down, you see a drop in the number of jobs that in that pay, the 8,000 to 15,000 rupees a month. And so when you come out of the lockdown, as the restrictions are eased, there are savings among the rich and deficits among the poor, because the poor had to still survive, still pay for food and basic clothing and basic telecom, etc., etc. And therefore, they had to shed assets or take on debt, and there was a lot of saving here. Now, as the rich then start to spend on travel, on tourism, on eating out, on coaching, on or construction, the savings start to flow, and the economy then starts to become more balanced. And we are seeing that, right? So if you, the biggest takeaway from the June quarter results, and I think that has continued into the September quarter results as well, September quarter business momentum as well, the evidence that even the independent home builder has now come back and is starting to construct is very clearly visible in the demand for cement, the demand for tiles, the demand for PVC pipes, the demand for cables and wires. And that, if all of that demand is going up, that means that construction activity is also going up, right? No one is just going to buy these and stock up, right? And construction jobs are exactly in that bracket. You are seeing a sharp recovery in travel and tourism, and therefore the bottom end of the K that you were talking about is starting to lift up. Now, one important overlay we must put on that is what's happening to the commodity prices and food prices and so on and so forth, right? So for example, if India is buying oil at $20 a barrel higher, and it was, I mean, when oil prices went, say, 80 to 100, you're talking about a $30 billion hit to the economy on an annual basis. And a reasonable part of that starts to flow through to the poor, through the plastics, the packaging. There was a big surge in global sugar and wheat and edible oil prices. And as those have corrected, now, of course, we are seeing an early part of the increase, and we need to be very cautious about, therefore, extrapolating on the decline. But at least so far, right, before this recent hike happened, there was clearly a drop in prices. You look at biscuit demand, there was stories over the weekend. Biscuit demand is rising like 15-20% because biscuit prices have started to normalize. So I think the demand conditions are...
That's the most interesting conversation with Nikunj Mishra, the snippets of which you can catch throughout the day only on ET Now. Kuwait Times Network also bring to you Mirror Now Summit Chhattisgarh, which is going to be held today in Raipur. As India's most influential news network, Times Network channels have been a catalyst for change and action for a better India. With the theme Path to Progress at Mirror Now Summit Chhattisgarh, we aim to showcase the journey that is leading the change in the sustainable agricultural revolution and enhancing farming methods for economic growth. Chhattisgarh's commitment to enhance healthcare is evident, with a focus on accessible, high-quality medical services for a healthier future, and highlight the state's rich culture and natural heritage as well. In fact, at the Mirror Now Summit, we will be discussing and deliberating with state leaders and authorities to define a holistic development agenda for the entire state. So get ready to catch all the action right here on the Times Network.
Catch Chhattisgarh's illustrious leadership offer a roadmap to fulfill the state's extraordinary growth agenda at the Mirror Now Summit, Chhattisgarh, on the 20th of September in Raipur. State partner, Government of Chhattisgarh.